Welcome to the daily update, where I'll go over the action in the market for Thursday, July 11th, and then we'll see how things look for Friday, July 12th. Had a down day for the S&P. That's what happens when the big mega caps and the semiconductor stocks experience some profit taking. It really drives the index down. But we're actually turning more positive when you look at the broad market. We're seeing the internals in the S&P show a lot of improvement, and the broader market, as measured by the NYSE, that's showing some renewed strength there as well. So even though it was a down day, it was positive when you look at the bigger picture. We'll have to see what PPI comes out with in Friday's session. Now, CPI came out on Thursday. It was weaker than expected. You pretty much have the market banking on this idea that there's going to be a rate cut in September, and that could keep things a little bit more positive for now. However, at the same time, why does the Fed cut interest rates? Is it because the economy's humming along and inflation is under control? That's what the market's going with right now. Other times when the Fed cuts rates, it's because the economy is showing some weakness. And that's not necessarily good for stocks because that bleeds over into earnings. So there's that fine line between this looking positive and this looking negative. Right now, the market is still looking at things being more positive. I do have a thing called the SPXInvesting Program. It's free and it's wide open for right now. It's where you get access to the daily video right after it's recorded and uploaded. There's also some additional videos that I put on the website that I don't put on YouTube or Rumble. If you want to access the website, there's a link in the description below the video. There's also a link to a playlist on YouTube that you can watch about the program itself. And there are also videos on Rumble to learn more about that. Here's an email address if you want to have any contact. Incidentally, while I'm thinking about it, if you do send me an email, and I like that, or if you put a comment on YouTube or Rumble, that's great. Of course, I wipe out all the spam stuff. Apparently, they're having some kind of a new webinar deal going through Fiverr or something. I've been just playing whack-a-mole like crazy, deleting all those comments, and I get rid of them as soon as I see them. I even get a few people that subscribe to the channel, but most don't. And it's like, okay, you're telling me you're watching these videos and you don't even know what they're about because I give an email address right there. Anyway, if you state something to me in either an email or a comment, whether it's on the website or on YouTube or Rumble, and you're saying something that seems to be a blanket fact, like something's happening in the economy or something's happening geopolitically in the US or outside of the US, can you please send links to what you're citing as your points? There is so much bad information on the internet and so much flying around on social media that people just take in and accept as fact. And I double check and triple check. I check everything as much as I can with sources that I know are to be true and reliable. And a lot of times people are making comments to me and I can't even find what they're talking about. I search Google, there's nothing about that. So I'm really trying to combat malinformation, bad information, misinformation, whatever you want to call it. We live in that age now where we have more access to information than ever, but it doesn't mean all that information is necessarily true. In fact, it means most of it is not true. It's just people stating an opinion and treating as though it's fact. So I love feedback and I like to interject into my thought process more facts, but I want them to be facts. I want it to be something that's actually said. And then even if you do send me the link, then we have to check, okay, is that source reliable? Because that's a big deal to me. I know a lot of people just take in things, over the fence type discussions with their neighbors, and you're stating different things as though they're true or not. I don't do things that way. I want to deal with as close to the primary source of information as I can, and then say, okay, here's the good, here's the bad, and here's the conclusion that we can reach from that. Anyway, it's been a little bit like that over the last few weeks, and I just wanted to state, please just send me your information source. I mean, if it's fact, that shouldn't be a problem. If you can't send a source, then I'm not going to believe that that's actually a fact. Okay. Anyway, I do post a lot of different videos. The basic video that I really rely on is the daily video, and then all the other videos that I produce are also supplemental to the daily video. Let's go back and talk about what happened. And it looked like, okay, things were going to be okay. We had a higher open, and that was enough. I had a few open positions that we got enough of an uptick right at the open to close out those positions. But then we reversed right after that, and we dropped negative. We fell below the daily pivot at 56.19. We tried to find support at S1 at 56.01, which now is also becoming a technical level, that 5600 level, after it pretty much had been psychological. And then that's usually what happens. First, it's psychological. The market goes, oh, this is kind of interesting. And it's a round number that people can talk about and throw about back and forth. Well, then it turns into more of a technical level. Then we did fall below S1. We didn't get all the way down to S2 at 55.70. And then we just chopped sideways. There really wasn't any convicted buying coming back in. The selling seemed to really slow down at that point. So the smart money just kind of let things drift sideways going into the close. We were down 0.88%. We were above average with volume. This is one of the few days that we've seen in the last few weeks where volume actually picked up. We're still positive in the short, intermediate, and long term. When we look at the S&P and the NASDAQ 100 itself, or themselves, they're still positive. This is just looking like a bit of a pullback. Now, we'll keep watching things, and if we see more weakness after this, we'll try to see is the climate shifting over to negative. Now, the perma bears, they're already declaring, oh, we've crashed already, and this is just the beginning. Don't pay attention to those yahoos. They absolutely don't know what they're talking about. Pay attention to the charts, and that will tell you what's actually happening, and you can see things unfold. In Thursday's session, it was about inflation and interest rates, and that was taken as friendly with the CPI report. We'll see if we see any more follow-through to that in Friday's session with the PPI. And then the whole geopolitical thing. Of course, we've got all the pop news going on right now in the U.S. about what's going to happen with the presidential election. And then next week is going to be the Republican convention, and we'll see if anything really shifts over to that, and if anything changes from what it appears to be right now on either side. Some comments: CPI was weaker than expected, and that was welcome. But at the same time, it's like, okay, we're seeing a little bit of this shift now. We saw the small caps and the mid caps do really well. Is that going to continue? Is this the start of something? Are we going to see more broad market participation? That's just what happened on Thursday. Now we have to see, are we going to shift over in the bigger picture? Mega caps and semiconductors underperform, as small caps and mid caps did see some strength. They were up pretty solid, but we've seen that before only to get faked out. We need to see more follow through in these other areas of the market. Our list is quite a bit shorter now when we're looking at extreme positive readings, the short-term overbought or extreme positive. We have the CCI 14 and 20 and the stochastics. Everything else is now fallen off. We've also become a lot shorter in the intermediate term, looking extreme positive with the Erin indicator, and it can take some time for that to kind of wake up and realize something happened. The Sean trend meter is still extreme, and then the boom based on 50 periods. So these lists were getting pretty long before. They've really shortened up, so we've been able to work off a lot of that extreme positive condition. In the long term, we're actually looking extreme with the 200-day moving average, and then we have the rate of change going back 200 periods as well. That's looking extreme, and this could be positive. We were down with the S&P and the NASDAQ 100, but yet we're seeing the longer-term moving averages show some improvement. The scenario at this point hasn't changed. If anything, the market seems a little bit more convinced that there will be a rate cut in September as rates stay higher for longer. The dollar was down and interest rates were down. We did see a pretty significant drop in the 10-year yield where it came down to 4.19%. And that could have given some support to the S&P and NASDAQ 100, but it didn't. But it did give support to the rest of the market. We had been at 4.28% with the 10-year. We're still inverted with the yield curves. We came back down into the neutral area as far as sentiment is concerned. We had drifted up into the positive side at 58. Now we're back down to 52, which is neutral. And then looking at our trend, we are in a confirmed uptrend. The ADX, this is something I've been trying to point out. We were looking rather extreme. Now it's still looking positive. The green line did come down, but the ADX is continuing to go up and it's above 40. And with the down day, our bias is now negative, and our momentum, though, I'm still keeping it positive because we just had that one down day so far. The economic reports that came out. This was the weekly jobless claims. It came in at 222,000, less than the 234,000 they had expected, and less than the 239,000 we saw last time. Continuing claims also came down just a little bit, from 1.852 million to 1.856 million. CPI, this was the big one. Here's the headline number. They expected it to be up 0.1%. It was down 0.1%. Last time it was unchanged. The market liked that, and that's what everybody, the CPI is under control. You have to remember, it also takes into account where we've been. So as far as, the high inflation that we saw earlier, that's still in the whole equation. It just means it's going up slower than it was before, but you still have to figure in all the previous high readings that we were getting. This was the one that the market paid attention to. CPI with the core came in up 0.1%. They expected it to be up 0.2%, and the market liked that. Last time it was up 0.2%. Year over year, that's 3%. Now, the Fed is still trying to get down to that 2% level, but this is more friendly, and it looks like things are moving a little bit better in that direction. So here is the year over year CPI, where we're declining with the total. That's the blue line. We're also declining with the core, and the market liked that. When we look at services and commodities year over year, when you take out energy, that is declining as well. And the core commodities, looks like they're bottoming out, but they have been declining. And then here's the weekly jobless claims. What we pay attention to the most is the moving average. It had been going up as we were seeing more initial claims being actually sought. Well, now the moving average has rolled over as we saw a drop off in this latest reading. And the continuing claims are rolling over, but the moving average is still going up. So to take it all together, the blue line or the red line are the initial claims, which are dropping off. We're still going up with the continuing claims. And then a week ago, we had the unemployment rate at 4.1%. Here's another look at that same chart to hopefully make it a little easier to see there. Here is CPI. When we look at a year over year basis, it has been coming down. It's leveling out, but it's still continuing to decline. When we look at the month over month reading, that is declining. And actually, the market is taking that as more friendly. Here is the core, which also is going down on a year over year basis and declining on a month over month basis. Here's some Isabel Net blog charts. Bull markets last longer than you think. We show this chart from time to time. It's kind of an easy thing for them to post, and people like these kinds of studies, where the average for a bull market is 61 months. And right now we're 21 months. So we're like a third of the way into it so far, if the bull market still continues. And then the 10-year T macro fair value. I'm not quite sure what all that means. This is the 10-year, the yield on the 10-year. And then this is what they're forecasting right around where we're at right now. So anywhere from 4.25% to 4.3% for the 10-year yield based. Now there's a fair value when it applies to stocks. I'm not quite sure how it really applies to interest rates, but I'm sure there's some kind of calculation out there. And then I showed this a week or two ago, and we were getting at very low levels here, meaning that Santa Claus didn't have any stockings to fill because there was a destocking cycle. Well, now it's starting to go back up. And that's what we were anticipating the last time we saw this. And so it's going back up, which could mean a little bit of strength in the economy. And then I have a couple of different ways of looking at this. This came out before CPI was released. And what is the number that came out? And then what does that mean month over month as far as looking forward? And they have these pretty little lines here with the different colors. I'm not sure how useful this is, but people like to look at things like this. And then this is put up by Stock Traders Almanac, the 12-month CPI change. And then they have pretty little rainbow lines going on here too. What the projections are going out as far as inflation. We're kind of in this, if you can see the pinkish gray or pinkish highlighted area here, that's kind of where the market is at. The Fed would like to get down to more of this gray line area. And then inflation has historically been more of a lagging indicator to earnings. That's the takeaway. I wouldn't necessarily try to figure out this spaghetti chart here, but that's what we see is that earnings start to get hit. And then after that is when we see inflation going either up or down. Or if earnings go up, that's when we see inflation start to go up. There were a few charts on Twitter, record low percentage of stocks outperforming the S&P, and hopefully this is starting to improve. We'll see if that actually helps things. But it's really just been a small number of stocks that have been helping the S&P. You can also say that for the NASDAQ 100. Financial stress is near all-time lows as volatility in financial markets remain suppressed. Now, we're going to get some big information on Friday. The banks are going to start reporting with their earnings, and they're seeing a low stress type of an environment. When you look at this financial stress indicator put out by Bank of America, is it going to continue to be low? Are the banks going to have good earnings reports and good guidance going forward? That could really help the market. That's why we watch the financial sector in every video. Then this is put out by Sentiment Trader. Then you've heard of the Hindenburg omen. That's, oh, the humanity. Well, there's also a thing called the Titanic syndrome as well. And this is just showing a really high reading right now. And you can go back to other times when we were up into this red area. And then sometimes this can mark a top in the market. Now, but this can still continue to go up further than where it's at right now. And then this is more for information. This is why I really rag on the perma bears so much. Look at all the blue in this chart. Those are bull markets. And the pink areas, those are bear markets. And as I say, as a general rule of thumb, the markets go up about 70% of the time. They go down about 30% of the time. But if you're a perma bear, you're bearish 100% of the time, which means 70% of the time you're wrong, which may work really well for baseball. But that's not good for us. It might be good for a batting average. But how many of you would go to a doctor that's batting 300 or an airplane pilot? Yeah, we have a 30% chance of getting you to your destination safely. No, you wouldn't stand for that. There's reality that we have to deal with here, that the markets go up and the markets go down. What makes it more painful is when they go down, they tend to go down fast and fierce, and it can bring a lot of pain really quick. That's why we look at things day by day, analyze them. If we are shifting over more negative, we can make money in those kind of environments. Or if you don't want to play that side of the market, there are things that we can do to protect what you already have in the form of hedging, where you're not going to make any money during that time, but you're not going to lose any money. And what you do lose is going to be replaced by the hedging that you put on your positions. Okay, and then S&P 500 earnings per share, actual bottom up. This just means they're actually, instead of looking at macro events across the economy, they're actually counting this up through the S&P 500 itself. And this is looking pretty rosy when we're going out here with the forecasts, and that justifies stock prices going up. Then we look at this on a year-over-year basis quarterly, where it is still going up for a while, but then they see it trailing off. This is going to change. They're just forecasts. They change all the time here. Then looking at our intraday chart, this was the nice little blip up that we saw right at the open. It looked like, okay, we're going to have a positive reaction to CPI. Well, that lasted all of about 30 minutes. And then boom, we saw some selling come in. We dropped below the daily pivot. We tried to find some support at S1. That wasn't really happening very much. And then we fell down below S1. We never made it down to S2. We actually kind of came down to the previous day's daily pivot. That ended up providing a support level. And we just kind of bounced around here going into the close. And we saw pretty much that same thing. The futures were just waiting in anticipation. There was initial upthrust with the S&P futures after the market, or after the CPI was released. That lasted just a few minutes, if even that. And then we saw immediate selling into strength at that point, and we got down to where that thrust up with the S&P futures. This is before the stock market even opened. We got back down to about the unchanged level, actually went a little bit negative, and then we started to repair things going into the open. That was carried over into the opening part of the day here, and you can see the gyration that we saw when CPI came out. But that just didn't last very long. And then we just saw a lot of selling after that. Then we're seeing a little bit of a change here. Value had a good day where growth just got hit hard. So the blue line's coming down, the red line's coming up, and they're just kind of having a little meeting right now between large cap growth and large cap value intraday. And we did see a hit here with our growth to value ratio intraday for the S&P. We'll watch to see if that still continues after it had been really going up overall. Our end of day chart growth was down over 2%, where value was up. And growth was up strong for the mid caps, but still up less than value. And it was also up for the small caps, but up less than value. You can see these other areas of the market just really had good days. But can it lead to anything going forward from here? So when we look at the small cap growth to value, it declined. Really not seeing any leadership there. Also declining with mid cap growth to value. Saw another day of decline here with S&P growth to value, but it's holding up a little bit better. But we want to see this turn and go back up to be more positive. And we saw a little bit of a hit here, but we're positive when we look at the growth ETF versus the value ETF. Saw a little bit of a tick up with discretionary, also a little bit of a bounce here with staples, but discretionary actually outperformed, but we're not breaking out yet. So things are improving, but we want to see more follow through to these things. Large cap growth did pull back after just setting new all-time high after new all-time high. Also pulled back when we compare large caps to small caps with this ratio. The Wilshire is coming off of setting recent all-time highs. Our trend, we're still going up with the ADX. We're above 40. The green line did come down below 40 though. And that was a bit of a concern in yesterday's video that both the ADX and the green line were above 40. We're still positive for the time being, even though we did drop off with the green line. And we're still going up with our short-term ADX. That's just heading to the moon, even though the green line did come down and also drop below 40. We did see a bit of a pickup with volume, at least for the day. We were above average. And we're getting into some slow average time now as we hit the dog days of summer, both on the NYSE and with the NASDAQ. Sentiment, not much of a change here with the Ulcer Index. We did get the latest reading at 3.5 for the Investors Intelligence, not necessarily extreme. We came up with the VIX on a closing basis, coming back up to the moving averages here, but the moving averages are declining. And we're coming back up with the bar chart, even though we closed off of the high for the VIX. And we've been seeing a little bit of a pickup with the volatility of the VIX, as the VIX, VVIX, is going up above the moving average, both with the bar chart and the line chart. And we're going back up a little bit here with our momentum as measured by the MACD, showing that the VIX is moving higher. And we're getting into that time now as we work our way through July, where we typically see really low readings with the VIX. And we're still seeing that, even though it's been going up, or it went up in Thursday's session. We will often see the VIX start to really pick up, at least on a seasonal basis. And then we're getting a signal again here with the skew index. We're up into this red area. So the market is expecting some kind of a big move. And we're also getting, this is more negative. This is when we take the VIX and the S&P and do a correlation. We're coming above this red dash, or this dashed line here. We don't typically see the skew index and this correlation generating a signal at the same time. Now, the skew index is more neutral because we don't know if it's going to be an upward move or a downward move. Where the VIX, the correlation, that's kind of like a pseudo VIX in and of itself. And that just means that fear is starting to increase as the market's getting more nervous. That could end up being negative. And we look at the equity put call ratio, which went up on the daily chart. And after being extreme, we're starting to tick back up with our 5-day chart. Here's the extreme reading. We're no longer in that territory. And we're starting to tick back up with our 10-day moving average of the equity put call ratio as well. And we're coming down after we were getting really, really high readings with volatility risk premium. It's still giving us a high reading, but in the context, it's coming down from those even higher readings we were seeing. We did tick down with this fear gauge, and we also ticked down with the other fear gauge. And this is more indicative of the broader market actually doing a little bit better. And this is actually improving. When we look at the spread between risky and not as risky bonds, you can't really tell by this chart. We also compare it with the VIX. This is a few days old now, but we're coming down a little bit with the S&P, but this is starting to go back up, and that's what we want. When we look at this inverted, that means this is going down. The risk between the risky and not as risky bonds is coming down a bit. And so the bond market likes that. And we've actually been coming up now with the inverted version of the VIX. We did come off of this high. We've been seeing a real move up with the risk on to risk off ratio. Well, it pulled back on Thursday. We did get the latest reading from the American Association of Individual Investors. They're above this 20 level, but not necessarily going really extreme positive, but maybe a little bit too positive at this point. And remember, that's you and me. We are the individual investors out there. The advanced decline line. This is what I'm finding encouraging here. We're turning up. We have not been able to get above this previous high with the advanced decline line based on price. But here we were down with the S&P, but the advanced decline line based on price was up, and we're still looking good, even though we were pretty much flat when we look at the advanced decline line based on volume. We're also seeing a real breakout in the new highs. That initial upthrust that we saw, that helped a little bit, but then the other stocks inside the S&P were still generating new highs. So this is looking more positive internally. So even though the S&P was down, there is some internal improvement that we're starting to see. We're coming back up with the 5-day, and we're already going back up with the 10-day. And this is another thing, the advanced decline ratio, even though we had a down day with the S&P, we are back above zero, both with the 19 and 39 measurement. And we're coming back down and no longer extreme when we measure the distance that the accumulation distribution is away from the moving average. So we've worked off that extreme reading, at least for the time being. This is a little bit of a concern. The Chaikin money flow continues to drop off. It's still positive, but the red line continues to go down. So that is concerning us. And we're also going down with the Chaikin oscillator. So all three of our smart money indicators are declining. The accumulation distribution is working off being extreme positive, where the second and third indicator are actually showing a little bit more weakness. But when we look at the broad market, the cumulative NYSE advanced decline line, it had a really solid up day, and our regular NYSE advanced decline line actually was able to break above this previous high. And we're also breaking above this previous high with our other regular NYSE advanced decline line. And we're going back up now with the common stock base for the advanced decline line on the NYSE. Also coming up with volume. We're coming back to this previous level with volume. We still have a ways to go based on price, but this is an improvement. We're also going back up when we look at price for the S&P advanced decline line based on the cumulative measurement here, going back up, but not back to this previous high, still continuing to go up when we do the cumulative measure based on volume. So again, this is more internal strength that we're seeing. We want to see more follow through here. And we're seeing an improvement between the S&P and the NYSE advanced decline line. The red line is going back up. Now it's still underneath. We want to see this get above the S&P bar chart here and actually show that the broad market's outperforming. And we're seeing an improvement here with our advanced decline line studies. Not anything too gangbuster yet, but it is looking better with the NYSE common stock coming back above the moving average, turning back up above the moving average with the S&P, even though it was down, coming back up to the moving average with the mid caps, and actually coming back above the moving average with the small caps. So this is more the internal strength that we're seeing. Here is the bar chart where we came right down to this pivot point, and that was probably the support level for the low that we hit in Thursday's session, and we actually saw a bit of a spike up with volume. Now, you could say, oh, the S&P was down on an increase in volume. Yeah, that's true, but you have to look a little bit deeper. The S&P was down, but there was an awful lot of improvement going on inside the S&P, which was probably where the volume was really coming from, and that would be more positive. And then we look at the CCI 14, it's coming down but still extreme, and the CCI 20 also coming down but still extreme. We're coming down with the short-term stochastic, no longer extreme, turning down but still extreme in the intermediate term, rolling over but still extreme with the long-term stochastics. This is still hanging in there for the time being, the 20-period double and triple exponential moving average study. We're coming down just a little bit below the lines, but for right now, both the green line and the blue line continue to go up. And this is another area. We had a down day for the S&P. The 20 period, the 50 period, and the 200 period all went up. And the Force Index did decline a little bit. It's based more on the price of the S&P itself, but it's still positive for right now. And we're still above the 20 period moving average. So these lines continue to go up. If we start to see more weakness here, yeah, we're going to start to adopt a new stance on things. But for right now, not an awful lot of damage was done. And we came down into the +2 channel, so we're no longer extreme with our standard deviations chart. And we're not extreme with the 20 period boom indicator, but we're still extreme with the 50. It takes a little bit longer for that to wear off. And we're still showing a little bit of an improvement with the 200. Where the balance of power ticked down, but it's still positive. We're still looking positive here with the go, no go with the darker blue bars. Coming off of the highest high value, still well above the midpoint. And we're turning a little bit darker now with the TTM squeeze. It's picking up that downward move, so it's looking a little more negative. And we look at our double and triple exponential moving averages based on 50 periods. Even with the decline, we're still above the red line and the blue line, and the lines are still going up. We're no longer extreme with the CMB composite. We're no longer extreme with the Connors RSI. We're pretty much flat with the ease of movement. The Erin indicator is still extreme positive, and it might take a day or two for it to wake up and see, oh, something happened here. This is another thing that we've been watching that's been causing us some concern. It's actually showing an improvement. Now, longer term, we're still seeing a negative divergence where we were seeing a high here with the McClellan oscillator and the S&P was going up. But the fact that this is above zero and going up, that is improving. So we're starting to turn up with the summation index based on price. We had already been turning up based on volume. And if you hear noise in the background, I apologize. There's construction going on here. We're also looking better with the broad market. The NYSE McClellan oscillator had come back above zero, and we are seeing that longer-term negative divergence. That has not gone away yet, but this is looking better. So we're starting to turn back up with the summation index based on price and volume. We're turning more positive here with the Swenlin trading oscillator. We're seeing an improvement based on price. We're improving based on volume, but we were actually flat on Thursday. And momentum is trying to turn back positive. We're a little above this red line, so we're still kind of extreme with the PMO, turning back up based on price, turning back up and looking even more positive based on volume. So we're going up with the PMOs that are rising. This is showing internal strength inside of the S&P. Also seeing that strength with the buy signals and turning back up with the PMOs that are above zero. We've gone from being positive to neutral with the Elder's Impulse system for the S&P. We're still positive with the parabolic SAR. We're flat now in the short term with our slope oscillator, looking a little more positive with the MACD. So we're looking pretty much flat, but still positive with the slope. The TSI is positive, but above this blue line, that could be extreme. Looking better in the intermediate term with the MACD, PMO, and PPO. Looking better with the tricks, but we're still flat. We're trying to turn up a little bit here with the KST. So momentum is trying to show some improvement. Still above all these moving averages that we have on this chart. So the short-term trend is still intact, and that is positive. This is another encouraging thing. Down day for the S&P, we ticked up with the bullish percent index. That means more stocks inside of the S&P were generating point and figure buy signals. And that's what's been concerning us. It at least improved in Thursday's session. We're also seeing an improvement with the NYSE bullish percent index and a little bit of a tick up with the NASDAQ 100 bullish percent index. The money flow is above 50, even though it was flat, but it's still positive. We're still coming down after being extreme with the ultimate oscillator. The vortex, after declining on an up day, that was a concern. We actually were flat, so that's showing slight improvement there. We're no longer extreme with the RSI 14 or 9. Unbalanced volume did decline. This is one of the older technical analysis indicators, and it was developed by Joseph Granville. And when we have an up day, all the volume is counted as positive. When we have a down day, all the volume is counted as negative. Now, we've come up with more sophisticated methods, but I look at unbalanced volume because a lot of indicators that we use are based off of the unbalanced volume. Standard deviation still climbing above the moving average, showing a little pickup in speed as of late. And this is another internal improvement that we're seeing. Longer term negative divergence, but those stocks inside the S&P above their 20-period moving averages, even though the S&P was down, this went up and showed a pretty strong move. So we're looking better. We're getting above this 70 level now with our steady. Now, we did see this initial thrust up, and then we saw some nice action after that. But then we've been just trailing down here, wondering, oh, only a few stocks carrying the whole market right now. We might be seeing a shift, but we're going to have to see what kind of follow through there is. We're also improving with those stocks above their 50-day moving average, and we're back looking positive above with those stocks above their 100-period moving average and turning back up with those stocks above their 200-day moving average. Again, remember, the S&P was down. All of these internal indicators were up. So that is showing some improvement. The copy curve is kind of right on top of its moving average. It's trying to cross over positive after being negative, but it hasn't quite triggered yet. We're still looking extreme with the Sean trend meter. And we're still looking positive here with our 5-period moving average of the highs minus the lows for the broad market. We're above zero and actually going up. We're getting a pretty healthy reading right now. And we're still looking good here. Longer term with the weekly chart of the S&P, even with the decline, we're still well above this R2 level. We'll have to see if we can close for the 4th week in a row now after Friday above this level. And we're coming back down. We didn't quite get up to the 61.8% fib extension with the S&P before we came back down. This still may act as overhead resistance if we continue to go up. On a trending basis, we're still looking solid with the hike in ASHI. We're still looking good with the KEGI, the Renko, and the 3-line break. It's like, what? We had a down day? You couldn't have told us that. Long term, we're seeing an improvement with a 150. After it had been declining, it did really go back up. We're also starting to get extreme positive again with stocks above the 200-day moving average, or excuse me, with the S&P above its 200-day moving average. Now, there's still this longer-term negative divergence that we've been seeing for most of 2024, but we are seeing an improvement as of right now. The rate of change going back 200 periods, we're starting to get up to this blue line, and that's a really long-term indicator, meaning that we still might be getting overextended to the upside. And then we're positive across the board now with the Keller market model across all time frames and all indexes. We're still negative with the long term based on bonds, where we're negative with commodities and the dollar in the short term. No changes with the decision point scorecard. Saw an awful lot of green or blue. Notice that these happened not too long after the market opened. That's when we saw that little tick up. And a whole lot of good things happened at that point. Then we started to break down, where we dropped below these different levels. But then we saw some other areas internally in the market as the things were unfolding throughout the day that were actually looking more positive from a technical perspective. So we saw real estate, which has just not been a good area in 2024. That was up the strongest in utilities, which have been under a bit of pressure lately, materials. And then the areas that were weak, discretionary, communication, and tech. These are the big growth areas. Now, we want to see discretionary doing better than it has been. And there has been some improvement as Tesla was seeing a bit of a bounce recently. But it's communication and tech that have really been driving things higher. So this is where we saw some weakness on Thursday as there was some profit taking. We're still looking good here. The NYSE new highs minus the new lows, getting a really strong reading at 270. And seeing an improvement when we look at the S&P to the equal weight S&P. The red line is coming up as the S&P has been coming down. And we're coming down with our ratio after getting to a really, really high reading here when we look at the S&P versus the equal weight S&P. The Dow was up and we closed right at this R1 level, just a little tick above it. We're still above the 50-day moving average. So we're still looking good, at least in an uptrend with the Dow, even though it's been chopping sideways. The diamonds still remain positive for the Elder's Impulse system with the Dow. And we came down just a little bit below this pivot point for the NASDAQ. We were kind of hoping that this pivot point might hold. We also came down a little bit even further below the pivot point with the NASDAQ 100. So there was some pretty decent profit taking on stocks that have really been doing well lately. And we've gone from being positive over to neutral with the Elder's Impulse system for the Qs. The momentum is turning down, but we're still above the moving average. So it continues to be positive. And we came up a little bit above this 50% fib extension. That was the high that we set. And then we came down from that level. And we're still seeing a longer term negative divergence here, where we just set a recent all-time high with the equal weight Qs, came down from that. We're showing an improvement with the S&P equal weight. It did go up, but we're still not setting a new all-time high. So the fact that it's improving, that's positive. The fact that there's still a negative divergence here is a warning sign. The small caps were up 3 1/3% here, coming up to the higher end of the range. Now, if they break out if they can finally, since the end of 2023, this is the top area that they've been getting to. If we can see more follow through to the upside, if the economy is really going into more of an interest rate friendly environment and the Fed is likely to cut rates, this will benefit small caps. We might end up seeing some kind of a breakout, but we've been faked out 3 times already. Is the 4th time going to finally be a charm? And we are positive with the Elder's Impulse system for the small caps. Also, the Russell 2000 small caps getting up to an extreme reading already with the RSI really broke out based on price above the 50-day moving average, and the momentum is improving, and the longer-term trend still continues to be positive. So there could be some good things happening for the small caps, but we've been here before, and we want to see, can it actually mean something now? The mid caps also, after just floundering and trailing lower, they shot up above their 50-day moving average and closed right at this R1 level, up almost 2.5%. They are positive with the Elder's Impulse system when looking at the mid caps. Coming off of a recent all-time high with the total U.S. stock ETF, Apple seeing a bit of profit taking. Tesla also some profit taking, down almost 8.5%. That's a pretty significant move there. Nvidia was down 5.57% after really doing well lately. Microsoft was down almost 2.5%. Meta was down over 4%. Amazon down 2.37%. You see all these percentage. That's why the S&P was falling. Okay, Google was down 2.93% as well. Netflix was down, was at 3.67%, coming back down to its 50-day moving average. This is why the S&P was falling. The FANG index really fell 3.5% after setting an all-time high. Financial sector, we've got the banks reporting, looking pretty good, up 0.79% above their 50-day moving average. Is this front running ahead of those bank reports coming out with their earnings? Is there going to be buy the rumors, sell the news? Just something to be aware of there. The staples to tech ratio ticked back up a little bit, but overall continues to decline. That is positive for stocks. The dollar, even though it was up in after hours, it ended up being down in Thursday's session. Seeing a stronger short-term correlation between the S&P and the world index, where we're still trailing off with the longer-term correlation. And looking a little bit weaker here with the staples sector, but still above its 50-day moving average. Also saw a nice little up thrust with utilities, up 1.83%. Real estate did see a bit of a breakout here, but we're coming back to previous levels. Can we get above that? And because that would be another area that would benefit from lowering interest rates is real estate, because it costs less for mortgages. Okay, the energy, it was up over 1% here, but still below its 50-day moving average. And we were down with the 10-year yield. That really helped give more of a positive backdrop for stocks, at least in the broader market. And we were up with the 10-year based on price. This is also encouraging. We've been watching this. The ratio between home construction and 3 to 7 year bonds, we came down to this 250-day moving average, and it looks like we're bouncing up off of that. Can this continue? Can it get back up above the rainbow? And then looking a little bit weaker here with our growth to value ratios, coming down with the Qs to S&P, rolling over a bit, but still above the advancing moving average with discretionary to the S&P. Large cap growth is coming down to the moving average when compared to large cap value. So we're seeing a bit of a downturn with the large caps, mid caps, and small caps. This is also improving. Our advanced decline ratio based on price, showing a nice little up move even with a down day. We also saw a nice little advance based on volume. We did decline a little bit with S&P to utilities ratio, but it has been going up lately. And I haven't shown this in a while. If we're actually starting to see interest rates fall with any significance, the decline in the 2-year treasury yield, which when it spikes up and starts to come down, that can often give short to intermediate term support to the S&P. And then we're also still declining here when we look at staples to the S&P, and that is more positive for the S&P. Now, we're dealing with a Hindenburg omen right now. We just had the first signal, and if you want to stop this and read through all this gobbledygook as to actually what it means and everything, the perma bears, this is like their holy text of everything's going to get ready to fall apart here. So we did see the initial spike. I did calculate it out. It looks like it will be around August 2nd. We're going to have to see another spike between now and that day. That's 20 trading days. If we get another spike, that could be pretty negative for stocks. Don't listen to the Parma Bears that they're saying we have another Hindenburg Ullman right now. We don't. It's a two-part signal. We've only received the first part. We have to see if we're going to get the confirmation. Now, if we do, yeah, we'll pay attention to that and possibly even turn more defensive. But we're not seeing any kind of a signal right now when we look at the NASDAQ Hindenburg Ullman. There's nothing that's being generated currently. And there was all these confirmations that happened, but the NASDAQ just kept going up anyway. All right, our outlook for Friday, we're turning more positive, or we're still positive technically, but the broader market is really showing some improvement. We want to see more follow through with that. Banks will be starting to release their earnings, and that's probably going to have a pretty big impact in Friday's session. We're going to get PPI and consumer sentiment. Both of those can be rather influential. And then all the crazy stuff going on in the world, just in case it impacts the market. And then we're finishing out the economic calendar for the week. And we're going to get the PPI on Friday. Seasonally, we do have a pretty positive day for the Dow, S&P, and NASDAQ. And we're also looking rather positive with the green dashed line during an election year for the S&P. So we have seasonality on our side for Friday's session. And Friday is one of the more positive days of the week. So we have that going for us as well. Longer term, we do tend to see an upward trend here in June, July, and August. Now we're hitting possibly some little bumps along the way in July as far as the S&P is concerned. And we're also seeing this positive strength, the 12-day mid-year rally for the NASDAQ. That could still come back, and we're still in that window for the time being. And this is a chart that I was showing, then it went away. Now I'm bringing it back. We actually tend to perform better during a non-election year when compared to an election year. It's a lot more choppy. I think this is because they're getting ready for all the conventions. I don't know. That's just pure speculation on my part, because for the most part, the stock market just ignores what goes on politically unless it's really drastic. And we're also wondering if there's going to be some more mean reversion where we're just getting way ahead of all the different averages that how we've been performing in 2024. And we're still in the first half of July, which tends to be positive. The second half, it's positive, but not really any strength is shown then historically. And we're also still in the first part of the month for July. So we're watching these defensive sectors, staples, utilities, and healthcare. We're kind of keeping an eye on energy just to see. Now, this kind of comes and goes, where I had really been focusing on this a few weeks ago, and it kind of seems to have drifted away now. Still keeping an eye on it for the time being to see if it ends up coming back. These are areas that we see strength in before the market is getting ready to be more defensive, which means negative. The advanced decline line is still showing weakness overall, but it has been improving. We want to see more follow through there. Growth to value, discretionary to staples, they took hits in Thursday's session. They're not leading right now. And we're going back up again with the 5-period and 10-period equity put call ratios. The copy curve just trying to cross over positive, but hasn't quite become so yet. And we look at our positive indicators, the accumulation distribution, it's been coming down. It's no longer extreme, but it is still positive. The Chaikin money flow is positive, but declining right now. And the Chaikin oscillator is also positive, but declining. These are our smart money indicators. The parabolic SAR is positive. We still are seeing a big improvement here with the S&P and NYSE McClellan oscillators and summation indexes, and they've actually turned over and looked positive. We did see an improvement with the bullish percent index for the S&P. The Swenlin trading oscillator, not as much based on volume, but we are seeing an improvement based on price. Our oscillators are trying to turn back positive, and we're looking a lot more positive with our 20, 50, 100, and 200 moving average studies. The money flow, the ultimate oscillator, the vortex is doing okay. At least it was flat on a down day. But these are still positive for now, and the bullish percent index for the NYSE is positive. The financial sector is positive, and even though we rolled over with the NASDAQ 100 momentum, we're still positive there, but the bullish percent index also continues to be positive. So our conclusion, we are positive, And this internal weakness, these negative divergences, they're still there. And the weakness is still there, but it's improving for right now. In the short term, we pretty much have worked off that extreme positive condition. Now we're at this point just looking at a pullback. And in the intermediate term, we're also seeing an improvement with the internal weakness that we've seen, but we still remain positive. We're also positive in the long term, and these negative divergences are showing some improvement with the longer term moving averages. Thank you. I really hope you found this helpful. I hope you have a really good day on Friday, and I will talk to you in the next video.